Good afternoon, everyone. Thank you for taking some time out of your day to join us for our webinar for this month, which is focusing on numbers. It's been a little while since we've run a webinar for clients and guests. Mostly it's been focused around JobKeeper and the various other government things of recent times. My plan is that over the next few months is to run one of these sessions each month, a little bit more of an educational type content, and this month we're looking at accelerating business through knowing your numbers. For those of you who are new to us, my name is Chris East, Director here at East Partners, and I'll be delivering today's session. If you haven't used Zoom before, I think just about everyone has used Zoom over the last few months, but just in case you haven't, audio settings at the bottom of your screen. There is a chat function. I've put a copy of the booklet that accompanies today's session in the chat, so you'll be able to download those as well. Any questions, please submit them through the chat button there. There'll be time at the end for questions, aiming to run today's session on for around about 45 minutes to then leave time at the end for questions. Raise the questions throughout the session. If I don't get to them as they're raised, I'll certainly get to them at the end. So it's good to start these sessions, and for those of you who have done sessions with us previously, you would have seen that I would have put these in beforehand. The budget is not just a collection of numbers, but an expression of our values and aspirations. So what does that mean? I guess hopefully you've all had an opportunity to update your budgets and forecasts to reflect the challenges of the cash flow of the COVID-19 situation. And if you haven't, I'd suggest that perhaps COVID is doing it for you. The numbers express your aspirations for your business over the next 12 months. And it's most important that you've got clarity around that. Now is the time to make sure that you understand, monitor and measure what you've seen in those budgets and forecasts, and what you've set in those forecasts. So today we're really looking at demystifying the most common reports you'll see, most likely from your accountant, but also potentially from the software that you use within your business to track where you are at. So what are we going to look at today? We're going to cover off the importance of knowing your numbers. I've said this, I think I say this to all of our clients, it's super, super important that you know your numbers, because they will tell you where your business is at. We'll take an overview of the reports that you should be looking at. The difference between profit and cash, a lot of these things trip people up. There is a big difference. Profit does not equal cash, and we'll talk a bit about that. Key drivers of business value, touch on briefly about protecting assets, adopting best practice, and how we can help in the process. I encourage you to make notes today. There is a little bit of accountant speak, which I am loath to use. Speaking Accountanese, as I call it, doesn't particularly excite a lot of people, and I certainly don't want to bore anyone with accountant speak. So I'll try and use as much practical terms as I possibly can in the content today. In my view, knowing your numbers is vital, as it allows you to interpret your reports and know if you're on track to achieve the goals that you've set in your business plan or your business recovery plan. And certainly we ran a session a couple of months back on business recovery planning. My top 6 reasons why you need to know your numbers, which I've outlined here. Firstly, they tell the story of your business. Numbers do not lie. They allow you to interpret the results of your business activity. They put proof to the activity that's been undertaken or perhaps not been undertaken. They help you to identify symptoms against root causes. For example, a decline in gross profit is a symptom of many root causes, such as ineffective pricing, reworks, poor purchasing decisions, wastage, a variety of others depending on the business. Knowing your numbers will also enable you to spot early warning signs of potential issues. An example of this is monitoring how long it takes customers to pay you, a very topical area, I think, at any time, but certainly now. But monitoring how long it takes customers to pay you allows to quickly respond if that number starts to increase, and invariably puts pressure on other parts of your business. Fourth point here, that they allow you to identify areas of strengths and weaknesses. Your balance sheet indicates whether your business value is going up or down. Very basically, if you're seeing a decline year on year, you can interpret that as being a decline in the value of your business. Understanding your numbers also means you have reliable financial information to base your decisions on. So it does support better decision making. And finally, knowledge is power. The more you know about your business, the better your business will be. And as I said before, the numbers do not lie. They will always tell the story of what is going on. So today we're going to review 6 key reports. Some of them I'll spend a little more time on than others, and I'm going to work through a case study which is based on a real life client to actually put some practical learnings around this so that you can take them away and apply them in your business. So first up, I'm going to talk about the trading account. And essentially the trading account tracks your sales. It tracks things like variable costs, gross profit, and so forth, which you can be then looking at in determining I guess your margins on what you're doing in your business, whether you're a product-based business or whether you're a service-based business. The gross profit percentage indicates whether your margins are improving or deteriorating. And if you've heard me talk about this, I would have explained it to you, but in case you haven't or your accountant hasn't explained it to you, we'll spend a little bit of time just illustrating exactly what that means. Small adjustments to this aspect of your financial statements can have a huge impact on overall results, which we'll demonstrate now. And the best way to do it is through an example. I'm looking at this. I've changed the name clearly to protect the guilty. So we're looking essentially at a retail type business. But it has the same sorts of elements if you are in a service-based business. So here is the trading account for this particular business, where we're talking about this business having sales of just over $1 million. They've got their cost of sales, which is essentially their stock purchases, allowing for movements of about 318, which then gives them a gross surplus of near enough to 700,000. Their direct costs are 450. We'll talk a little bit about what that means in a moment, which gives them a surplus from trading of near enough to 250 and a gross profit margin of 24%. Now, on face value, you can look and say, well, that could be okay. But in this particular client's case, they came to us and said, look, I'm finding some challenges in being able to pay for the rest of my expenses, and I'm not getting the return that I would like to be able to fund my life. So I need some help. So essentially they came to us for some coaching. So we looked at implementing some strategies to increase their customer retention rate, which resulted in an increase of 10% on their sales. We also looked at how they could possibly reduce the amount of inventory that they were carrying. And in this particular case, it was resulted in a 5% decline in their inventory costs. They were also able to renegotiate some contracts with their delivery provider. In their particular case, they had a handful of different couriers or delivery companies that they were using. So we looked to consolidate so that we could get some trade discount, which then allowed us for some saving. As a result of those changes, their gross surplus increased by $140,000, and their gross profit margin went up to around about 35%. So there wasn't a silver bullet clearly in this case. There was a few different strategies, but looking at 3 key projects and then working through on implementing those over a period of time enabled a clearly or a demonstrable change in their gross profit margin. So understanding the key drivers in behind these numbers, customer retention rate increased meant an increase in sales. A reduction in inventory costs translated into a reduction in their or an improvement in their gross trading. And from that, adjustments to their delivery provider then enabled an improvement in their gross profit margin. I'll move on to the profit and loss. So the trading account more or less is the top part of a profit and loss. The next part I'm going to look at is looking at more of the other costs associated with running a business. A profit and loss statement, sometimes it's called an income statement, but I'll just stick with a profit and loss for all clients on the line. You'll know that terminology from us. It essentially shows your earnings and costs that have been incurred over a year and tracks the overall performance of your business. It matches your income and expenses for that period of time with adjustments made for, sometimes there's some timing adjustments. Let's say, for example, you've made some sales, but the money hasn't been banked yet. Or you've got some inventory like we had on that last slide, but it hasn't been sold yet. So it's shown up in a closing stock figure. Essentially, the profit and loss statement provides a framework to benchmark your results by using percentages or comparisons between years to compare performance, not only of your business, but it could also be benchmarked against similar businesses in your industry. And businesses are generally valued by using a multiplier of earnings. So your profit and loss statement is a real driver in determining what the value of your business can be. So what does all that mean? We're now looking at the operating costs associated with this business, or essentially everything else that is that falls outside those direct or those direct costs that we were talking about earlier. Direct costs being the cost of your stock in a product-based business, the cost of your delivery and so forth in that sort of business. If you're a service business, generally it's wages, it might be contractors, it might be those labor costs that you're incurring to produce the service that you're delivering to your clients. All right, so let's have a look at this, at what we did in this case and what some of this analysis means. So we've taken the gross surplus from the trading statement, which is the 248,749 at the top. And as you can see, this business at the time was making a loss of 114,000, hence why the business owner came to us and said, well, we're not overly happy, and we clearly concurred and said, well, yes, there are some issues here. Let's see what we can do to fix them. So as part of that review, we looked at the expenses and we identified there was some ability to make some savings in insurance and rent. Now, they were modest savings, they were a reduction of 5%, but hey, they were still a reduction. One thing you will notice, though, that came out of this analysis is that the accounting fees at the top went up by a fair bit of money. Now, remember, as I said before, this client engaged us to be able to look at some turnaround strategies for their business. So, You know, none of us work for free, and in this case, yes, their accounting fees were doubled. But what you can see, whilst you know the accounting fee went up substantially or doubled, their bottom line increased massively. So clearly, going from a $113,000 loss to $140,000 profit through the implementation of a few of these strategies, or identification of the strategies first and then the implementation, was clearly, in their case, worth their investment. Every business, I would argue, has sleepers within their profit and loss. Some are perhaps more lean than others. In some profit and loss, you can make some significant adjustment. There's a lot of fat in there. Some of it might be lifestyle related. Some of it is just from poor decision making by the business owner. And in a lot of cases, it's simply, I just don't understand what these numbers mean. Taking the time out to actually look, well, what are the drivers behind these numbers and what can I do, can potentially, as you can see in this case, pay off in a fairly substantial way. I'm going to move on to the balance sheet of this company now. And essentially, as I said earlier, very crudely, it can measure what a business is worth at any point in time, or at a point in time. A balance sheet, I would argue, and this is just my opinion, I think it's more powerful than a profit and loss, only for the view that it tells you if you're solvent or not. And by that, it's what do you have versus what don't you have. And what you have is an asset, and what you don't have is a liability. So clearly, if your assets are higher than your liabilities, logically you should be, and I say should be in inverted commas, but you should be solvent. So let's have a look at this particular balance sheet for this client. Technically, you could argue that this company's insolvent because they're running a negative $305,000 in net assets, or by that, assets minus liabilities. When we look at their current assets over the long term, the company could look at some strategies to be able to reduce their debtor days, reduce their inventory days to increase their cash flow. What does that mean? Well, it's getting these numbers down. It's reducing the amount of inventory that's been held, perhaps through better purchasing decisions, and it's actually looking at how do they offer their terms of credit to their clients. Are they a little loose with that? Arguably, in this case, you could say yes. So yeah, I just mentioned the term debtor days and inventory days. Well, what does that mean? Essentially, debtor days, you take your debtors, or what's owed to you by your customers, and you divide them by your sales, and then multiply that by 365. So essentially what that says, it gives you an average of how long does it take for your customers to pay you. In this particular case, the company's debtor days are 26. So on average, it means that from the time that the invoice is raised, it takes 26 days for their customers to pay. If they were to update their terms of trade, let's say, for example, when requested a payment term of 7 days, they're not necessarily going to get every single client to go to 7 days. That would be utopia, but it's not going to happen. But what if they were to shift it by 5 days? That would reduce their debtor days down by 5 to 21, and potentially an additional nearly $14,000 would be made available. And I've illustrated this now just on the screen of what I've been talking about. So similarly with inventory days, take your inventory costs and divide that by your cost of sales, which was back on the trading statement. Multiply it by 365, it gives you a rough indication of how long a business is holding the inventory before it's sold. So how long is your cash tied up in inventory? And similarly with receivables, how long is cash tied up with your customers? How many customers are you giving more or less an interest-free loan to before they pay you? In this particular case, inventory days came out to be 74. So you could imagine it's a fair amount of time having cash tied up in inventory before it is sold. So looking at ways to be able to improve inventory. So in this particular case, we looked at the current process, which was very lackadaisical, worked with them to put in a more structured process around the ordering and maintaining management of inventory, which then led to a reduction in their inventory days by nine days. And in their particular case, meant a cash flow increase of around about $8,000, which combined with the $14,000 of reduction in debtor days through nearly 22 grand into their bank account. Little strategies, as I said before, no silver bullet, but combined together start to produce some good outcomes. Right, so I'm just going to chat quickly about the statement of changes in equity. This doesn't always apply to every business, and perhaps for you on the line who may be running, let's say a company, maybe a trust, say unit trust, this is perhaps more of a relevant number, but at the same time, you can apply a similar logic if you're running as a sole trader type business. And essentially what this document or what this report tells you is, where did the profit go? That is perhaps one of the more common questions I'm asked when we're presenting a set of financial statements after the end of financial year to a client. And we look at the bottom number, and the client looks at me and says, well, where'd that money go? I don't have that money. These figures can't be correct. We then have a look at, well, this report, where has the money actually gone? So we look at this and we say, well, in this particular case, the company had accumulated losses for at least the last 3 years. So essentially it meant that the company had no retained profits, no retained earnings, and leading to that, I guess, insolvency concept that we spoke about before, where they have a negative $305,000 of assets. There's no money technically to pay out a dividend, and essentially no money to reinvest in the company to purchase new assets, because the equity's not there. The cash isn't there. It's tied up in other aspects of this business. So essentially the business owner looked, and once we got to this point working through with them, they said, well, yeah, we can't reinvest. We don't have money. How do we turn that around? So when we then looked to turning that around, we then made reference then to what the shareholders' accounts were. Now, in a trust, this could be the beneficiary account. In the case of a partnership, it could be the partner accounts. And in the case of a sole trader, it would be the proprietor's account. All of those concepts would show on a balance sheet, and all of them more or less mean the same sort of thing. Here we're talking about the shareholder account because we're talking about a company. And in this particular case, it shows that at the start of the period, the company owned its shareholder about 29 grand. Helps if I go forward. There we are. There we go. Entry, yeah, there we are, 29,000 at the top. All right, so the shareholder had introduced 2 grand into the company during the year, but had then pulled 9 grand out to pay various other personal costs, which then meant at the end of the year, the loan account had moved out to around about 22 grand. The amount owed by the company to the shareholder can only be repaid clearly if the company is solvent and it has the cash to be able to make the repayment. In this particular case, again, I'll use the word, it's technically insolvent. Very difficult to be able to do that. And really the shareholder was left in a position whereby the only way to get that solvency was to make cash injections themselves. So to ensure the company will be able to repay the funds that have been introduced, clearly a profit improvement strategy is required so that the company can then be profitable and in turn be able to meet its obligations in a more timely manner. As I demonstrated back in the trading account and the profit and loss statement, examples of those strategies that were implemented and how they could improve in a profit improvement. And in that particular case, it was a turnaround from a loss of 113 to a profit of 138. It's not sustainable, clearly, without taking some action. If this client hadn't have taken action, their business would not have been sustainable. They would not have returned to a profitable position. The fixed asset register, otherwise known as a depreciation schedule, which most businesses will have one of these. And essentially what does it do? Well, it records the assets that are held by a business. It reflects those things that have been purchased that will be held for a extended period of time. Generally larger items such as vehicles, such as we're talking about a food business here. So we're talking about cool rooms, we're talking about ovens, we're talking about kitchen equipment and so forth. We're not talking about things that will be consumed in a short period of time. Essentially why these are kept is that or these registers are kept, is that they keep track of the business assets. Now, in the current environment whereby we have immediate write-off of assets, sometimes those things can be lost. And we certainly like to be as clear as we possibly can with business owners to make sure that whilst they're getting a tax advantage to an immediate write-off, that the fixed asset register is in fact maintained so that they know pretty accurately what they have on their balance sheet in terms of the assets that they hold, and in turn that's pretty helpful to have that when the business is to be sold. Okay, so let's have a look then at the fixed asset register for this business and some of the things that we work with this business owner around. The first column of the fixed asset register lists the names of all the assets, pretty evident. The second column lists the costs. Across then it's the opening value, which is usually the value after a series of years of depreciation being applied. We've got a purchase here for a website and a security camera system. We've got some disposals, write-offs of some assets, invariably because they've either gone past their use-by date or they've been superseded by a replacement asset. We talk about the method of depreciation being used. DV in this particular case stands for diminishing value. It's not a major issue for you to worry about. The concept though is just to be aware then that depreciation is calculated to give a closing value. So most of you, if not all of you on the line, will have a depreciation schedule or a fixed asset register. Which is used then to support the value of the asset that's shown inside your balance sheet. It's, as I said before, it's important to make reference to your fixed asset register to make sure that the assets that are on there are still in fact owned. It's easy to put this one aside because an asset was purchased 4 years ago or possibly longer, and it may not be used in your business anymore. And therefore should be written off. Now, whether that gives a tax outcome or not is perhaps a separate conversation, but it's certainly important to be aware of well, what is showing, and when it is then being used to support a business valuation, if your business is going to be sold, or if you're looking to introduce an equity partner or something like that, it's really important that the incoming party know what they are buying, and it's therefore supported by one of these documents. So I've run through rather quickly in terms of the 6 key reports that should be produced. Now we certainly produce these annually for clients, but for most clients now, particularly if you're using software such as Xero, these sorts of things you can get your hands on relatively straightforward if you know where to look. Most importantly though, each report tells a different story, and it's understanding that story about your business that can aid in the decision making in a different way. Now, if you've got any questions about any of these reports I've shown and you haven't flicked a question through at this point, please feel free to do so, and we can address those. Now, I want to get to this because this is super important. I've talked about improved profitability and how it gets this particular client out of their predicament. Now, I like this. This terminology, and it's so true. I've had clients over time that get so excited about their turnover. Their focus is their turnover. It really floats their boat. But turnover is vanity. All it does is just makes you feel good. There's no real substance to it. Profit is, as I've put here, sanity. It's more of what it's about, but the bottom line is that cash flow is your reality. If the money's in your bank account, you can't dispute that. But if you've got it tied up in areas on your balance sheet, as we illustrated earlier, in something like customers owing you money, or in your inventory, or in other areas of a balance sheet, maybe a lazy asset register, or maybe in inappropriately structured debt, there could be any sorts of issues there. Ultimately, it's going to come down to your cash flow, because cash flow is the reality. And in this particular case, the business owner was frustrated their bank account didn't seem to reflect, well, initially, their profits. Clearly it didn't, because they were running such a big loss. But it does take some time, and as I said before, sometimes we will have conversations with business owners and they'll look at their profit and loss statement and they'll say, yeah, but where's the cash? Because it ain't in my bank account. It's essential to understand the difference between profit and cash, because it doesn't necessarily mean, just because you've got a high profit, doesn't necessarily mean you'll have a high bank account. A profitable business can still go out of business because it's starved of cash, and invariably those businesses are ones which have got poor control over their numbers. Now, I'm going to talk about where some of these things go, because these, and certainly our experience and experience with clients, is where people can get tripped up. GST has an impact on your cash, because the GST isn't yours. You're the unpaid tax collector for the government. So effectively, you're collecting it and then passing it on. So it does have an impact on your cash. Similarly, loan repayments, they are a cash item. They do not affect your profit. Interest on loans, however, has an impact on profit and loss, and as a consequence of that, is able to be, in most cases, claimed as a tax deduction. So it's important to understand the difference there. It's the principle on loan repayments is only going to, well, both interest and loans affect your cash, but it's the interest component that has an impact on profit. Asset purchases, clearly, you got to pay for those. They don't have an impact on profit. Asset sales, similarly, they have an impact on your cash, but the depreciation of those assets impact your profit. So the purchase and sale affects the bank account. Depreciation affects your profit and loss. Clear difference. And actually, just to go back to that slide, the interest on loans and depreciation invariably is a darn sight less than what the cash outgoings are associated with these things on the screen. Now, I've used this chart before, but just to reiterate in terms of the, if you like, the business cycle, the business 101 cycle, I call it. It's another useful way to demonstrate the difference between profit and cash. Firstly, the owners need to invest money in the business. That's just simply what happens when a business is acquired. This money can then be used to purchase assets that are needed to run the business. The business may need additional funding, such as through loan finance. These assets are used then to generate a profit. You can increase your profit by growing your sales or margins, as we identified earlier, but overhead expenses can drain your profit, and if they're not managed, turn it into a loss. Then profits get turned into cash. The drains on your cash flow include slow collection of debtors, monies from your customers, higher inventory days, loan repayments, tax repayments, payments to suppliers. A business can achieve cash gains by collecting their debtors faster, decreasing their inventory days, negotiating longer payment terms with suppliers, and obviously reducing their tax. And then in turn, the owners then take cash out of the business, such as personal drawings or loans, however they take the money out. So the remaining cash is then reinvested into the business to purchase more assets to generate more income, and then the cycle goes around again. The aim is to go through the cycle as quickly as possible to increase your return on your investment. That's the logic. As we showed earlier, the business that we used in our case study today had challenges around getting around this wheel as quickly as possible because there were some inefficient and arguably lazy aspects that they had in their business. But through the implementation of a number of strategies, it meant that there was some improvement in not only their profit, but in their cash position. So after cash flow, business value is the next most important measure of a business success, arguably. Part of knowing your numbers is understanding and measuring the drivers of your business value. So these values might include, say, monthly recurring revenue or revenue growth, revenue per customer, sales or profit. So it's really saying what are the key things that drive this business. Look, they're called key performance indicators or KPIs, but in all practical terms, let's actually look at the things that deliver or drive the outcomes in your business. And they'll be different for every business, but it's important to be or to understand what they are, because those are the things which, if you spend, probably the 80-20 principle really, if you spend the bulk of your time improving those, the rest will take care of itself. So enhancing the value of your business, it's really important to first develop and implement a clear plan and document things such as organisation structure, who does what. Now this still applies even if you're a single operator or maybe a mum and dad team. It's still important to understand who does what, because without having that documented, it just sits in someone's head. There's no accountability, and it's arguable if it ever gets done, and if it does get done, does it get done properly? Having cloud-based real-time reporting allows you to make better decisions, and reviewing and documenting your systems and processes ensures your business is running as efficiently as possible. I mentioned prior that something like Xero allows you to have real-time reporting. For those of you that are clients, you know that I think Xero is terrific. They don't pay me to say that. I just think it's wonderful. It allows us as the accountant as well to have real-time discussions. And let's face it, everyone needs advice pretty much straight away in the current environment that we're all in. Reducing the reliance on the owners of the business can also help enhance the value, as it makes it easier for new owners to take over. So looking at growing, or not so much growing, but certainly having a business that has greater value, in a lot of cases, take the business owner out, you're left with nothing. Finding a way to reduce the reliance on an owner means that the business inherently has more value. It's little wonder that a lot of the franchise models that are out there are so expensive to buy, because essentially it's a turnkey operation. You don't need to be relying on the business owner to make it work, because there is a system behind it. And finally, identifying and managing risks means that these can be mitigated before they become an issue. So we spoke about earlier in terms of understanding, having a knowledge around your numbers, of being able to manage those risks, because clearly this business, if they had have left those numbers unmanaged for any longer, they would no longer be with us. So why else is it important to know your numbers? Well, it's really important to know your numbers, because you want to be protecting the asset, not only the asset that you've built up, but the asset that will continue to fund you into years to come. As we've seen through the conversation that we've had today, the profitability, cash flow, and value of your business all have an effect, and they affect you personally. Any business that isn't profitable and doesn't have much cash available won't be able to pay its owner. And in turn, the owner doesn't have the lifestyle that they want. That's not going to be a happy person. Now, certainly at the moment, yeah, there are some challenges in some industries around the COVID situation that is causing challenges to be had. Arguably, it is then up to the business owner to say, well, how do I then move my business into a state whereby I will be able to have the lifestyle that I want? But not knowing what your numbers are telling you, you really are limited in terms of what you can do. All right, so a few other things you can do in terms of protecting assets. Look, and this stems from what we've spoken about today. Limitation of liability typically comes from a company or a trust structure. In terms of a business, well, who should be a director of your company, and which assets are held personally by directors? Having clear understanding around who should be sitting in what seat is super important if you want to then protect an asset. It doesn't make a lot of sense having a low risk party then taking on a high risk position. Ensure that you've got security over any money that's lent. Look, pretty obvious sort of thing. Ownership options for high value assets, and that could potentially mean if the business owns, let's say, commercial property, moving the ownership into a separate entity. It's certainly my view that having a active entity, and I call it an active entity being a business, versus a passive entity being an investment structure, is a much better way of going, and the two of them should never interact, insofar that having, let's say, for example, commercial property inside the active entity that's doing the trading, if that entity fails, well, that asset is lost. If that asset was in a separate entity, it's then protected. In terms of trade and credit policies, look, I see a lot of businesses which don't have trade terms with their customers, and if they do, they're really loose. In a lot of cases, there's no due diligence done. Essentially, it's a new customer rings up, hey, I want to engage you for this. Business owner says, great, off they go. Not necessarily looking at the history of the person who they've engaged. Rack up a bill, do all this work, person disappears. Insurances, yes, insurances make absolute sense. Planning around finances, again, fairly self-evident, and certainly making sure that there is an estate plan for the future. Now, the reason that I've put these in is that they are all interlinked. You need to be aware of your numbers, because if you're not aware of your numbers, all of these areas, there are problems. Okay. How do we adopt best practice? Essentially, these are the three tools that I feel in my time of advising business owners that I think are really important, is the annual plan, the annual forecast, which oftentimes are interlinked, and ongoing reporting and accountability. Knowing your numbers is just the beginning, as it allows you to improve them and ultimately achieve your goals for your business. Now, having these things in place will enable you to be able to get greater clarity and certainly greater engagement with what your numbers are telling you. All right, so let's make this practical. Get started now, essentially, as the slide says. These are challenging times, so there is no question. And my aim, as I've said on previous sessions, is to help you take what you've learnt in these sessions, and including today, and implement some positive change in your business. Now is the time for you to decide what you're going to do. So I encourage you to take a few minutes after the webinar to write down 3 actions or projects that will add value to your business. What are the problems that you're currently experiencing? And identify these problems and use them as an opportunity to create a project to fix them. You know, doing nothing right now should not be an option. I've said that probably for the last 6 months, really, since COVID things started. Doing nothing is not an option. As attractive as sometimes burying the head in the sand might be. So how can we help? Well, look, in this particular client's case, and we illustrated it in the numbers, their accounting fee increased from about 4,000 to 10 grand. Now, that encompassed looking at doing some planning, dovetailed into a cash flow forecast, and then there was some ongoing management and assistance. But in their particular case, they took a $100,000 loss to a $100,000 profit. So the additional investment that they made in that particular case, near on 6 grand, produced a 200,000 result. Now, I'm not saying that we'd guarantee that in every case. It's certainly not that. But what it is illustrating is that an investment in your business to be able to identify strategies to be able to achieve improvement, regardless of what it is, whether it is something for reducing inventory, whether it is something for reducing debtor days, even if it was simply on something, I need to get some clarity around my own cash flow requirements so that then my business can fund my lifestyle. It really doesn't matter what it is. If you don't currently have a business plan, well, clearly, we can help with that. And the same with ongoing accountability, certainly ongoing reporting. And I certainly do know that it's difficult to commit to spending right now. Ultimately, though, you've got to look at it and say, well, do I want my business to flourish now and into the future? Or am I going to take the path that I've always taken and expect a different result? And I think we know that that invariably doesn't achieve too much. Right, I have time for some questions, and I have a couple. Which, just bear with me. Right, what is the difference between the annual accounts and accounts that can be produced throughout the year? That's a really good question. And essentially, the annual accounts contain year-end adjustments for things like depreciation, tax, taking loans and splitting the principal and the interest, If there's been cases of where there's been prepaid accounts, so let's say you've paid insurance for the next 12 months, that needs to be adjusted for. And there's lots of other accountanese jargon that I could bang on about, but I don't plan to. But if, essentially the main difference is that the annual accounts are historical, whereas your regular management accounts give you an idea of your up-to-date information. All right. What's the difference between markup and margin? Yeah, it's a good one. So yeah, so I have spoken about gross margins, and yeah, is it the same as the markup I can put on my prices? Well, yes and no. The markup is the dollar terms, or the markup in dollar terms is the same as the margin essentially, and in both of the difference, if you like, between the cost price and the selling price. But in terms of percentages, markup and margin are not the same. So for example, if you bought stock for, let's say $75 and sell it for 100, your markup is 33%, being 100 divided by 75. So whilst the markup is 30%, or 33%, the margin is 25%, being the $25 profit, which is divided into the sale price of 100. So it's a little bit of a tricky one, but sometimes, yeah, whilst margin and markup can be used interchangeably, they don't necessarily mean the same thing. All right, is there any other questions? Yes. Why do you need to have the two, markup and margin? Yeah, that's a great question too. So essentially what you want to look at with a markup, you want to look at markup first up, in my view, to determine, well, how much should I be selling my product or service for so that it covers my expenses? And typically, if you've ever seen me draw the upside down pyramid where I have the what do I need and what are the costs in achieving what I need to then determine the sale, that's roughly the methodology which would determine your markup. Now that could be at high level, or it could be just simply on a product, and then with an implied cost structure put behind it. Whereas a margin, where I see margins being of perhaps the most practical use is when I would be explaining to a client their annual financial results, and we then use it in terms of percentages. And I would then say for every dollar of sales, you're receiving, let's say, 80 cents after you've paid your direct costs. So as a margin, that's 80%. Or your net profit is, say, 20%, or for every dollar of sale, you've got 20 cents in your pocket. That's probably where I'd use the margin concept. So in terms of practical examples, that's why I would argue that you would need to have both, but they're both used in different contexts. So hopefully that explains that. If there is no further questions, or if you'd like to reach out directly, look, feel free to do so. If you haven't downloaded the workbook from the chat panel, please do. And hopefully that puts some more practicality around what I've spoken about today. The financial statements that get done each year, I think in the past, and I'm going back a period of time here, but I'd say in the past they're invariably put in the bottom drawer of a business owner's filing cabinet, because all they want to know is, well, how much tax do I have to pay and how much do I have to pay the accountant? Possibly still for some business owners. I would argue though that in not just the current environment, but I think because as life has become more competitive, the numbers have become more real for some. But it's the challenge of then saying, goodness me, I don't want to become an accountant. I don't need to have to, understand all of this terminology. I just want to get a basic grip on saying, well, how does this work? And hopefully that guide will help. Obviously, if you want to have more engagement on that and want to really get your numbers cranking for you, I'm happy to have a conversation. So thanks again for making the time to attend today. I really appreciate you taking the time out. And yeah, hopefully we'll all re-engage again next month for our next topic. Thanks again.